Okay, let's unpack this. We all heard the advice, maybe from our grandparents, maybe from a financial advisor. Don't put all your eggs in one basket.
Right.
It's the foundational concept of diversification. It sounds like simple, folksy wisdom.
And that common wisdom is powerful because, well, it's intuitively correct. But as you rightly point out, intuition doesn't really cut it when you're dealing with complex markets and, real capital.
Exactly. Our listener is smart. They want to move past the vague advice. They want to know, how do we actually take that ancient concept of risk spreading and reduce it to a rigorous, quantifiable science?
And that is our mission for this deep dive. We are plunging into one of the most intellectually foundational concepts in modern finance,
hmm
modern portfolio theory, or MPT.
This is the framework that mathematically defines risk, return, and portfolio structure. We're basically translating spread your risk into precise equations and graphs.
We've drawn this material directly from the core fundamentals of MPT, from sources that look at its revolutionary origins, though highly specific and sometimes criticized assumptions it makes about how you, the investor, behave.
Ah, yes, the perfectly rational human.
The perfectly rational human. And most crucially, the sheer computational mechanics required to actually optimize a portfolio using this theory.
We're going to uncover who formalized this theory, why risk is measured using volatility instead of just losing money, and how MPT creates the ultimate investment roadmap, the efficient frontier.
It's a journey from common sense to calculus, and it really does deliver some fantastic aha moments about the nature of market relationships.
So let's start at the beginning. Before MPT, what did the world look like?
Well, we start with a financial world that was operating largely on instinct, and we're going to see how one man turned it into a formal, measurable discipline.
If you look at the investment world before the mid-20th century, say the 1930s or 40s, diversification was practiced, but it was largely a qualitative concept.
It was. Investors knew they shouldn't be 100% invested in one stock, but they couldn't mathematically measure the benefit of adding a second, or a third, or a fourth asset to the mix.
So it was more of an art than a science.
Absolutely. That's the critical historical context. Investment strategies were often based on selecting good stocks, assets that looked undervalued based on their fundamentals, their revenue, their management quality.
Right. The focus was almost entirely on the intrinsic value and expected return of the individual asset.
Yes, not on how that asset interacted with others in a group. They knew diversification was a good idea, but they couldn't articulate why beyond the simple idea of, avoiding total failure if one company went under.
So if I had stock A and I decided to add stock B, there was no way for me to definitively say, because of the relationship between A and B, I have reduced my overall portfolio risk by precisely X%.
Exactly. The benefit of diversification was a mystery until 1952. That's when Harry Markowitz, who was just a graduate student at the time, published his now iconic article, Portfolio Selection, in the Journal of Finance.
It's remarkable how one academic paper can literally shift the foundation of an entire industry.
It was seismic. I mean, Markowitz essentially formalized investment management. It was so foundational that it was recognized almost 4 decades later, earning him the Nobel Prize in Economics in 1990.
Wow.
And what MPT did was shift the focus from evaluating individual securities in isolation to evaluating the portfolio as a single combined entity.
So MPT provides a mathematical framework for constructing and selecting portfolios based on two main variables: expected performance.
And the risk appetite of the investor. It forces the manager to define their goal before they even start choosing the assets.
And defining that goal requires defining risk. Before MPT, risk was this vague idea often associated with the probability of ruin or maybe the chance that a company might fail.
It was very amorphous. Markowitz gave us a measure that applied universally. He demonstrated that the variance of the rate of return is the meaningful, quantifiable way to gauge portfolio risk.
Okay, so let's dig into that. Why variance? Why not just track, say, the maximum drawdown or the worst possible historical outcome?
Because variance and its square root, standard deviation, captures the variability of the rate of return. See, risk in the Markowitz world isn't defined just by losing money. It's defined by how much the returns of an investment are expected to fluctuate around their average.
The unpredictability.
The unpredictability. If the returns are expected to jump wildly from plus 25% one year to minus 15% the next, that high variance translates directly to high risk. It measures volatility, that unexpected movement, which is the very essence of market uncertainty.
And crucially, MPT then used standard established statistical concepts to define diversification itself.
Precisely. It mathematically defines the benefit of mixing assets using covariance or correlation between those assets. This is the key insight we have to internalize.
Hmm.
Diversification works not because you own many different things.
But because those many different things react differently to the same economic forces.
That's it. If they all move together, you gain nothing.
So Markovitz's genius wasn't inventing the concept of spreading risk, but inventing the mathematical tool covariance to measure the efficiency of that spread.
Absolutely. The analogy our sources provided is actually excellent for anchoring this abstract concept. MPT is like hiring a professional nutritionist to plan your diet.
I like that. Okay, so expected return is the energy, the calories you want to maximize.
Exactly. And risk, measured by variance, is the potential for an allergic reaction, the volatility you want to minimize.
Okay.
And the nutritionist doesn't just look at the calories of the steak versus the calories of the salad. They look at how those foods interact in your body. Does the combination of two ingredients cause indigestion?
Do they work together to create sustained energy?
Precisely. MPT uses correlation data to construct a portfolio that maximizes your expected energy, your return, while minimizing the chance of an adverse volatile reaction, which is your risk. It's turning investment choice into an optimization problem.
It provides a rational, measurable recipe. But the recipe only works if the chef, the investor, is entirely rational, which brings us to the core assumptions MPT is built upon.
Yes, MPT is a beautiful theory, but its mathematical elegance rests on making very strong, sometimes unrealistic assumptions about the investor. It assumes we are all perfectly rational actors, operating under specific economic rules.
Let's start with the central purpose then, the goal of this rational investor.
The first primary assumption is that investors are driven by a singular goal: maximizing expected utility over a specific holding period.
And utility here just means satisfaction, happiness from wealth.
Essentially, yes. This means they aim to maximize the return for any given level of risk they are willing to shoulder. The corollary to this is the pure efficiency rule. If two assets have equal expected returns, the rational investor will always select the asset with lower risk.
Always.
Always. They're never compensated for taking unnecessary volatility.
That seems to dismiss entirely the field of behavioral finance. You know, the fear, the greed, the herd mentality that dictates so much real-world trading.
It does, and that's MPT's primary theoretical friction point. For the math to hold, MPT assumes the investor's decisions are based on only two factors: expected return and risk, which is variance.
That's it.
That is it.
Yeah.
Therefore, the investor's utility curves, their personal map of satisfaction, are a function of only those two variables. Nothing else, not market sentiment, not news headlines, influences the rational MPT investor.
So if I am an MPT purist, the only thing I care about is the mean and the variance. The rest is just noise.
Precisely. And this leads us to the third and perhaps most fundamental economic assumption: the concept of diminishing marginal utility of wealth.
We hear this term often, but let's be explicit about what it means in a financial context.
It means that the incremental satisfaction, the per dollar or per rupee increment to utility, decreases as an individual's total wealth increases.
Right.
Think about it. Finding $100 on the street is a massive utility boost for someone who only has $100 to their name. But finding $100 is negligible for a millionaire. The marginal utility has diminished.
And why is this principle so foundational to MPT? What does it unlock?
It mathematically justifies risk aversion. If the satisfaction you gain from making $10,000 is less than the emotional pain and practical disruption you'd feel from losing $10,000.
Then you'll demand some compensation to even enter that scenario.
Exactly. You need to be paid a risk premium to offset the disproportionately painful experience of a potential loss.
So the rational investor operates under the principle that loss hurts more than gain satisfies, even if the absolute dollar amount is the same. That's the engine of risk aversion.
That's the engine. And while different investors may have different rates of decrease in that marginal utility, some may be extremely risk-averse and some less so, the principle itself holds for all rational actors. Crucially, the assumption means that investors will not take on additional risk unless they are compensated with a higher expected return.
They require a premium.
They require a premium.
This structure seems to be built to remove human error. By presenting every investment alternative as a probability distribution of expected returns, MPT allows the investor to bypass emotion and just logically weigh the likelihood of different outcomes against the average.
That probability distribution is key. If you have asset A, MPT doesn't just show you that the average return is 10%. It shows you the full spectrum. The probability of hitting negative 20%, 0, 10%, or 30%.
And once you have that full picture.
Once you have that distribution, you can calculate the expected mean and, critically, the expected variance, which is the risk. This structure moves the decision from subjective judgment to objective measurement.
Perfect. With those rational actors and their utility curves defined, let's see how they translate their personal relationship with uncertainty into 3 distinct risk profiles.
Well, the fact that MPT uses probability distributions confirms that more than one outcome is possible. That's the existence of risk. The measure of compensation demanded for bearing that uncertainty is the risk premium.
And that risk premium is essentially the market's price tag on volatility.
Exactly. To understand how investors react to it, we first need to define the baseline. A fair game. A fair game is an investment prospect that carries a 0 risk premium.
So its expected return is just the risk-free rate, or sometimes mathematically, its expected payout is 0.
That's right. There is no excess reward for the risk you're taking.
And how does the predominant investor profile, the risk-averse actor, treat this fair game?
A risk-averse investor will reject a fair game every single time. They only choose risk-free opportunities like treasury bills,
Right.
or if they venture into risky assets, those assets must promise a positive expected risk premium.
They must be paid to take on volatility because of their diminishing marginal utility of wealth.
Exactly. And this demand for compensation isn't static. It scales with the risk involved.
Ah, okay.
This is a key insight for you, the learner, to understand the geometry of this. So the risk-averse investor, as risk increases, their demand for a risk premium also increases. If you want them to move from a portfolio with 5% volatility to one with 10% volatility, the required expected return jump will be substantial.
It's not a linear relationship.
Not at all. It's likely more than double the premium they demanded initially. Their indifference curves, the lines mapping equally satisfactory risk and return combinations, they get steeper as risk increases.
And this preference is formalized by the MPT calculation of utility scores.
Yes. Higher utility scores are assigned to portfolios that successfully maximize return while minimizing volatility, the better risk-return trade-offs. A higher level of risk generally results in a lower utility score. It acts as a mathematical penalty for volatility in the eyes of that rational, risk-averse investor.
This brings us to a crucial practical measure used by analysts to compare investments, the certainty equivalent rate, or CER.
The CER is great because it translates the abstract utility calculation into a tangible comparable rate. The CER is the rate a risk-free investment must offer to be considered equally attractive as a specific risky investment.
So it asks the question, what fixed, zero-risk return would make you indifferent between that and this volatile stock portfolio?
That's the question. And based on the investor's risk profile, their calculated CER will determine their choice.
So a highly risk-averse investor, they might look at a portfolio promising a 15% return with high volatility.
And assign it a CR of only 2%, even though the risk-free rate is, say, 3%. Because their perceived risk is so high, their CER is below the risk-free rate, and they reject the risky portfolio.
But a less risk-averse individual.
A less risk-averse individual might assign a much higher CR, say 10%, to the very same portfolio, indicating that they find the potential reward compelling and they accept the investment.
So CER isn't just a measure of the portfolio, it's a reflection of the investor's soul, mathematically quantified.
It is the mathematical intersection of the investor's psychology and the portfolio's statistics. Now let's look at the other theoretical extremes in the NKT world, the risk-neutral investor.
This person seems to defy that core tenet of diminishing marginal utility.
They do, at least in the classic sense. The risk-neutral investor evaluates opportunities solely on expected return, with no regard for risk. They apply no penalty for risk in their utility calculation.
So for them, a coin flip where you can win 10,000 or lose 10,000 has the same utility as just keeping your current wealth.
Exactly, because the average outcome is 0. Their portfolio CER is mathematically equal to the expected rate of return. Volatility is irrelevant, only the average outcome matters.
And then we have the genuine thrill seeker, the antithesis of the rational actor.
That's the risk-seeking investor. This person is defined as one who will willingly engage in a fair game, even where the expected return is 0, and makes an upward adjustment for utility when risk is present.
So they actually like the variability itself.
They get a higher utility score simply because the investment is volatile. Now, while MPT assumes most players are risk-averse, these extreme profiles are necessary to map the full theoretical spectrum of human choice.
It's a remarkable framework, moving from personal preference to rigorous measurement. Now, let's get into the true computational guts of MPT. How Markowitz requires us to calculate not just expected return, but that crucial measure of interconnected risk.
All right, when we move into the actual numbers, MPT requires two core statistical inputs for every single asset: the expected rate of return and the expected risk.
Okay, calculating the expected rate of return, the RA, is straightforward probability. It's the sum of potential returns multiplied by their corresponding probabilities.
Exactly. If we estimate three economic states, boom, normal recession, we average the outcomes weighted by the chance of each state happening. That gives us the mean.
That's the first moment of the distribution. But MPT needs the second moment, the risk. And risk for an individual asset is defined by the variability in return. Our measure is the standard deviation, which is the square root of the variance.
This choice standard deviation is central. Why is it superior to simpler risk metrics?
Because of the underlying assumption of MPT that asset returns are often normally distributed. They follow a bell curve.
And if returns follow a normal bell curve, the mean and the standard deviation, the first and second moments, are statistically sufficient to describe the entire distribution. If you know the mean and standard deviation, you can calculate the probability of virtually any outcome,
So a larger standard deviation just means the bell curve is wider.
which indicates a greater dispersion of returns and therefore larger risk.
Okay, let's talk briefly about the mechanical steps to get to that number. But let's focus less on the arithmetic and more on the conceptual purpose of each step. We want to understand why we are doing it.
Good idea. The goal is to measure how far outcomes tend to stray from the expected mean. So we first compute the mean return, then we calculate the deviation of each historical return from that mean.
How much did it miss by?
Exactly. The critical step is squaring those deviations.
And the purpose of squaring is twofold, right? First, it gets rid of the negative numbers.
Absolutely vital. It ensures all values are positive. You don't want a huge positive surprise return canceling out a huge negative surprise return. Both deviations represent variability, and both are risk in the MPT sense.
And second,
Second, and this is key, squaring amplifies larger deviations. A return that is twice as far from the mean contributes 4 times as much to the variance, which correctly reflects the exponential increase in risk represented by those extreme unexpected outcomes.
we then average the squared deviations to get the variance, and finally take the square root to get the standard deviation. That gives us a single universally comparable number, like the 9.40 our source cited for that mutual fund, summarizing its inherent volatility.
And that's the individual asset. Now, when we combine them, the calculation for the portfolio's expected return remains simple.
Right, the expected portfolio return is the easy part. It's just the weighted average of the expected rates of return for the individual investments.
If you have 60% in asset A and 40% in asset B, the portfolio return is simply 0.6 times A's return plus 0.4 times B's return. Crucially, this calculation does not require correlation coefficients.
Because returns are additive.
They are. But calculating portfolio risk, this is where the complexity explodes exponentially. This is the hard part, because risk is not additive.
Why is it not additive?
Because the total risk of the portfolio depends on how the assets move together, which is exactly what diversification leverages. Portfolio variance requires two components: the weighted averages of the individual variances,
Okay.
plus the weighted covariances between all the assets in the portfolio. The variances are on the diagonal of the calculation. The covariances are all the off-diagonal interactions.
So even for a simple 2-investment portfolio, the formula already contains 3 terms: the variance of investment 1, the variance of investment 2, and the weighted covariance between them.
That weighted covariance term is the core MPT innovation. It's calculated as 2 times weight, 1 times weight, 2 times the correlation coefficient between them, times the standard deviation of 1, times the standard deviation of 2.
So that little r in there, the correlation coefficient, that's the magic number.
That single number dictates the extent to which you achieve diversification. If R is +1, you get no benefit. If R is -1, you achieve maximum risk reduction for that given return.
The correlation coefficient determines the strength and direction of the interaction, and thus the true portfolio risk. The introduction of this single variable takes the complexity from linear to exponential.
It does, which leads us to the overwhelming data challenge MPT presents in practice.
Right. When we talk about MPT, we are often talking about the difficulty of the calculation required to derive the portfolio variance. We saw that for 2 securities, you have 3 terms.
Yes, n equals 2 gives you 3 terms. Let's scale that up conceptually. How quickly does the calculation grow?
The complexity scales quadratically. For a three-investment portfolio, you have the three variance terms and then three covariance terms. 1 and 2, 2 and 3, and 1 and 3. That's 6 terms total.
And as the number of securities N increases, the number of required covariance terms grows much, much faster than the number of variance terms.
And the formula defining the growth of those crucial interaction terms is what exactly?
It's a combinatorial challenge. The number of covariance terms is n squared minus n divided by 2. This is the key insight into the computational barrier of MPT. If you are managing a large, globally diversified fund, you might have hundreds, if not thousands, of available assets.
Let's put this into tangible terms for the listener. We're not talking about a 500 stock portfolio, just a modest, professionally managed basket of 50 securities.
For a portfolio of just 50 securities, the number of individual weighted variances is 50. But, using our formula, the number of weighted covariance terms that must be calculated and estimated is a staggering 1,225.
1,225 relationships that need to be defined mathematically just to correctly measure the risk of the total portfolio.
It's immense. And it underscores why MPT really only became a practical reality with the advent of powerful institutional computing power.
It must have been purely theoretical for decades.
Largely, yes. These 1,225 coefficients form what is called the variance-covariance matrix, or VCM. This is a crucial tool in asset management. The diagonal of this matrix contains the individual variances, the asset's standalone risk, and every off-diagonal cell contains one of those 1,225 covariance coefficients.
And if even a small percentage of those inputs are wrong,
the resulting optimal portfolio allocation MPT suggests will be completely skewed.
the ultimate goal of diversification is to use these 1,200 terms to reduce the total variance of the portfolio by selecting assets whose correlations are as low as possible. But how do professional managers even begin to estimate all of those correlations? Historical data is notoriously unstable, especially during market crises.
That's the real-world friction. This estimation problem is precisely why Markowitz's pure MPT model often fails in practice, leading to the high estimation risk we talked about. Because calculating 1,200 historical correlations and believing they will hold true in the future is, well, it's naive. Practitioners often have to simplify the problem.
What's the common simplification?
The most common is the use of factor models, like the single index model developed by William Sharpe, who was a later Nobel laureate building on Markowitz's work.
How does that help?
Instead of measuring the correlation between asset A and asset B directly, you assume their movement is primarily driven by their relationship to a single common market index, like the S&P 500. This drastically reduces the calculation load from that huge combinatorial number down to just in beta coefficients, the sensitivity of each asset to the market.
So we're trading mathematical perfection for practical tractability. It's a necessary compromise, but it means we're no longer using pure MPT.
Exactly. But let's circle back to the pure MPT concept to highlight the importance of those 1,200 terms. We must understand the case where they are entirely worthless. Perfectly correlated assets.
When the correlation coefficient is +1.
If every asset in your portfolio moves exactly in tandem, MPT proves there is absolutely no benefit of diversification. The assets do not offset each other's volatility at all.
So if we plot the risk-return opportunity set for two perfectly correlated securities, what does that look like?
It's just a straight line connecting the 2 points. The portfolio return is simply the weighted average of the returns, and the portfolio standard deviation is simply the weighted average of the individual standard deviations. You get no risk reduction for combining them.
It's just an average of the two assets.
That's all it is. The beauty of MPT is that it graphically shows you the benefit. As the correlation drops below +1, that straight line begins to curve inwards and to the left, creating the famous umbrella shape. The further to the left the curve bends, which means the more portfolio return you get for a given level of risk, the more effective the diversification.
So the whole effort of the variance to covariance matrix calculation is essentially to find combinations that minimize those correlation coefficients, creating that beautiful inward curve.
Once we have successfully navigated the computational gauntlet, calculating all the expected returns, variances, and those thousands of covariances, we can finally plot the results. This massive data visualization is the efficient frontier.
This is the visual core of MPT, the payoff for all the mathematical heavy lifting. It's an umbrella-shaped curve plotted on a graph where the vertical axis is expected return and the horizontal axis is risk or standard deviation.
This curve represents the boundary of possibility. By definition, the efficient frontier is the set of optimal portfolios. Every single portfolio lying on this curve offers two things simultaneously: the highest possible return for a given level of risk.
And the lowest possible risk for a given level of return.
It's the ultimate trade-off menu.
So if you're looking at all the portfolios that didn't make it onto the curve, what defines their failure?
They are suboptimal portfolios. Portfolios below the frontier are inefficient because you can achieve that same level of risk with a higher return just by rebalancing your allocations. They are not providing enough return for the volatility they contain.
And portfolios to the right of the curve.
They're also suboptimal because you can achieve that specific rate of return with a much lower level of risk. They are unnecessarily volatile.
And the defining principle of the entire frontier is that if you are already on the curve, you cannot get a better deal. Any increase in return for a portfolio that is already on the efficient frontier requires an increase in risk.
There is one exception. The point at the far left tip of the umbrella, that's known as the Global Minimum Variance Portfolio. This is the single portfolio combination that achieves the lowest possible volatility regardless of return. From that point upward, every step of increased return requires a risk concession.
This entire modeling exercise is known as the portfolio optimization process.
Right. It's a deterministic mathematical procedure to generate that efficient frontier, a combination of investments having desirable risk-return characteristics within specified constraints.
Now, once the efficient frontier is mapped, the final choice needs to be made. This is where the rational investor we defined in Section 2 meets the market reality we've just calculated.
Precisely. This is the moment where the investor's individual utility curve meets the market's possibilities. The rational investor will search along the efficient frontier for the point that is tangent to their highest possible indifference curve.
And that point of tangency is the investor's single optimal portfolio.
It is. A highly risk-averse investor will choose a point closer to the low-risk minimum variance portfolio. A less risk-averse investor will choose a point further up and to the right, accepting more volatility for a higher expected return.
It's elegant. It provides the perfect blend of objective market analysis and subjective investor preference. But let's bring back the dark side of MPT, the one we flagged earlier. Estimation risk.
Yes.
If the entire output, the shape and location of this beautiful frontier, depends entirely on the quality of the inputs, isn't the entire structure fragile?
It is extremely fragile, and that is the central critique of MPT. The portfolio manager has to estimate three things for the entire investment universe: expected returns, standard deviations, and, critically, the correlation coefficients.
All 1,225 of them for a 50-stock portfolio.
Yes. And if you misestimate any significant portion of those, the efficient frontier you generate is simply wrong.
And since we use historical data, which is really the only data we have, to predict those inputs, we are inherently assuming that the future will look statistically similar to the past.
That is the core vulnerability. For instance, correlations between assets tend to spike toward +1 during financial crises or black swan events.
Everything falls together.
Everything falls together. If you relied on correlations calculated during a period of stability, your MPT-optimized portfolio will severely underestimate the total risk you face when the market panics, because the assets you thought would protect you suddenly start moving in lockstep.
So in the practical application, the calculation often necessitates specialized tools to handle the sheer volume of the variance-covariance matrix. But regardless of the computing power, the garbage in, garbage out principle still applies.
Absolutely. If your estimates are flawed, your optimal portfolio might actually be dangerously suboptimal. The final selection of the optimal portfolio from the efficient frontier is determined by the investor objectives and constraints. Things like liquidity needs, tax concerns, regulatory limits. But the geometric shape of that frontier, its menu of choices, is fixed by the estimates.
Which creates a permanent tension between theoretical perfection and practical uncertainty.
It's the central problem of modern finance.
What Harry Markowitz achieved was, a monumental leap for finance. He moved diversification from a vague concept, the intuitive fear of putting all eggs in one basket, to a quantifiable mathematical science.
He did. MPT rigorously links investor behavior through the concept of utility and risk aversion to the mechanics of portfolio construction, using the powerful tools of variance and covariance.
And that framework is enduring. MPT gave us the mathematically sound way to find the best menu, the efficient frontier.
And the complexity, which we've seen demonstrated by the exponential growth of calculations, specifically the 1,225 correlation coefficients needed for just 50 assets, that highlights the enormous analytical power and computational challenge inherent in applying the theory correctly.
The elegance is undeniable, the rationality of the model is captivating, but we have to acknowledge the limitations. The MPT framework is deterministic. It tells us exactly where we should invest, based on perfect data. But that leads us to the final provocative thought for you, the learner, to carry forward.
Since the accuracy of the final optimal portfolio relies entirely on estimated future expected returns, estimated volatility, and estimated correlations, all of which are calculated using past data, we must ask this. If the central mechanism of diversification, correlation, is notoriously unstable and jumps toward one during periods of crisis, how much faith should we place in a theory that uses the statistical footprint of the stable past to predict optimal future outcomes during times of instability?
The theory is sound.
The theory is sound. The inputs are the constant headache of every sophisticated